Hello, welcome to the final episode of 2024. We're going to be looking at the tax rates for retirees in Ireland. So, this applies to anybody basically that's drawing an income, be it a state pension, or if they're prior to state pension, before they're in receipt of the state pension, they're drawing ARF income or the rental income coming in. Hopefully, this will give you a bit of a gauge in terms of where and what your gross to net might actually look like, because that can be a very big deciding factor in terms of how financially independent we are. If we think, oh, yeah, look what I need, 4 grand a month to cover the basics, well, you have to generate 4 grand a month. So if you're generating taxable income, for argument's sake, if it's via rental property or if it's drawing income from an ARF or an annuity, they're taxable income. So it's important to understand what you need to be generating gross, so that after tax you have the 4 grand for illustration to cover your basics and to ensure you can survive and buy Christmas presents and go on Christmas party nights out and all those fun things that we try and do at this time of the year, if that's your cup of tea. Speaking of cup of tea and warm fluids, I'm a little bit better this week. Hopefully, I don't sound quite as guttural as I did last week. And I hope you're well. So, I'm going to talk about tax rates. I'm going to give you a couple of different scenarios. So, 3 scenarios with 3 different incomes. I'm going to look at couples and indeed single folk in terms of what the gross to nets incomes could potentially be. I'm not going to dilly-dally, not going to delay you too long, dear listener or dear viewer, if you're watching this on YouTube. And indeed, you can be dear reader if you go to informeddecisions.ie and check out the blog section. You can find the written version of all of this. And make sure to stick around to the end, where you can potentially hear a little Christmas number from yours truly. Yes, indeed. It's a tradition at this stage. And next year, I hope to bring some fresh content, fresh ideas, fresh insights for you, dear listener. So be sure to keep your eyes peeled for new stuff in January from me. Some great interviews lined up for next year as well. So look forward to continuing the journey, continuing the learning. We're all learning. Somebody said to me, I think it was Pete Matthew in the UK from Meaningful Money, podcasting is like learning in public, something along those lines. Totally misquoted him there. Apologies if I have, Pete. But check out Meaningful Money in the UK. Incredible resource and center of excellence. Okay, so I've used PwC and Deloitte income tax calculators for the purposes of looking at these different scenarios to work out gross to net and the different scenarios. So there's a bit of looking at this, and I've made every effort to ensure its accuracy. But of course, like anything, please do your own due diligence. Don't just take my word for it. These are specific scenarios, specific circumstances, specific incomes. Really, they're intended as a bit of a guide and an indicative illustration of how things could be. So, scenario A is where we have a married couple in receipt of 2 state pensions. Married couple receiving the full state contributory state pension in 2025 will earn €289.30 each per week. It's a lot. That's €30,087 per year gross that they're in receipt of from the max state pension. It's fantastic income. It's really great. Is it enough to cover all of your expenditure? For most people, it's not. And for most people, they would want to have more. Not everybody does. But that's what the full state contributory pension is now. Max. And it goes up slightly if you're over 80. Once you have to meet the minimum criteria, the qualifying criteria, of course. But if you don't meet the full criteria, then there's lower bands. If you have the full 2,080 PRSI contributions. Happy days. 289 and 30 cents next year. So what's the tax breakdown on that? Okay, so well, if 30,000 coming in, you're paying tax or you're not paying tax. Well, if you're age 65 or over, a single person can receive 18,000 a year, totally exempt from income tax, whereas a couple is double that. So it's 36,000 per year, paying no income tax. All right. So if if you're a couple, you're obviously in receipt of state pension, you're obviously over 65, you will pay zero income tax on that 30,000. Happy days. If you're under 65 and you were to receive 30,000 as a couple, you'll pay a tiny amount of USC and some PRSI, zero income tax due to credit. So your effective tax rate is about 5%, right? 5% only. But if you're over 65 in receipt of the state pension, as it is in this case, of 30,000, you pay no income tax. USC, you pay €240 per year. And PRSI for over 66s, there is no PRSI for people over 66. So the great news is you have a total effective tax rate, give or take 1%, right? For over 65s in this scenario. It's really fantastic. So you're taking home 29,844, I make it, of your 30,087. You're paying very, very little tax on just the state pension. All right. And that's assuming you both have maxed the state pension for 2025. Happy days. You're taking it's 100%, 99% you're taking home. Wonderful. Okay. What if you have other income? Let's say you have 40,000 of ARF income, pension ARF income. So you have the state pensions locked in, the very same again, €30,087. And let's say you have a pension pot of $1 million, you're drawing 4% a year from that at the moment, for argument's sake. So you have total household income of €70,087. Well, income tax at the 20% band, there's 13,608 at the 20% band. And then tax, you're just above and just into the higher tax rate there with those combined incomes of €816. Total income tax of 14,424 before credits. Applying the tax credits, which in this scenario work out at just under 8.5 grand, you are therefore liable to income tax of just under 6,000 on that income of 70,000. USC of just over €1,000 on that income. PRSI, again, given you're over 66, exempt. So there's just under 7,000 of total tax due on that €70,087 annual income. It's quite surprising to an awful lot of people that you've a household income of 70,000, but you're only paying 7 grand in total tax. It's a 10% total effective rate on that income. So when you hear people saying, "No, don't put money into pensions," and we had one guest who did say such a thing, don't put money into pensions because you'll just pay tax on it. Well, yeah, you'd pay tax on every income, but it's 10%. It's 10%, particularly when you look at you're getting either 20 or 40% tax relief on the way into the bloody pension. In that scenario, you have a pot of £1 million, that at 4% plus the state pension, you're only paying 10% tax on what you're drawing out. And it's also grown tax free while it's in the pension. So pie in the sky, I'm afraid. But wonderfully low rate of total effective tax of 10%. All right. To be commended. And that is the reality in that kind of a scenario. So your net take home is 63,000 of the 70,000. Marvelous. I'd have that all day long, says you. What about if you're under 65? So if you've retired early, for argument's sake, and you have an ARF, or you have pension pots, or you have annuity, and you have a bit of rental income, whatever the makeup is, you have 70,000 of income coming in, you're under 65, let's say you're in your 50s, or whatever the case may be. There's no age-related credit, and you are paying PRSI. The total effective rate, if you have 70,000 household income in that kind of a scenario, it's marginally higher at 15%. It's still only 15%, right? It's not 20 or 30 or 40. 70,000 over 65, you'll pay 10%. Under 65, it'll be in and around 15% approximately. And it does depend on the breakdown of those incomes, right? So this is assuming one person has the ARF and drawing that. So that's an interesting one to note. What about scenario C? This is where we're getting into the higher rates of income. So in this scenario, the couple are receiving €30,087 from the state pension again. And importantly here, each person has a pension slash ARF slash annuity that's generating 40,000 per year each. So they've 30,000 state pension, 40,000 ARF, 40,000 ARF. So they've total income here, household income of 110,000. Importantly, both person are earning similar portion of the income. Right? It's not all weighted on one income, which does make a difference because you can utilize the standard cutoffs. So it generates, in this scenario, it's generating more than sufficient income so that they can leave their other savings untouched, growing, compounding for future gifting and enjoyment. But hey, what's the tax rate like when you have 110,000 retirement income? Thanks to both having the ARF income here, as I mentioned, the first 88,000 is at lower band and taxed at 20%. So that's 17,000 at the 20% bracket. And then the remaining 22,000 in this scenario is taxed at 40%, which is just under 9 grand. So total income tax before credits is 26,000. So 26,000 on the 110 before credits. Take off the credits of 8.5 grand. Total tax liability is income tax liability is just under 18,000 on that 110. USC of 1,841, PRSI exempt. So total deductions in this scenario are 19,786. So what's the total effective rate? Well, the couple are taking home 90,000 of the 110 in this scenario. So that's a total effective rate of 18%. 18%, not 40, not 45, not 50, 110,000, 18% total effective rate. Thank you very much indeed. Both parties in this household having income above the standard rate cutoff has helped. If that was all weighted on one person, there would be a higher rate of tax. And what about if you're under 66? But it's 18%. Again, going back to my point, if you're getting the higher rate tax relief on the way into a pension, for argument's sake, and I know I'm talking about pensions a lot here, but that's the reality. People think, oh no, don't put money into pensions because you get tax relief on the way in, yeah, but then you pay tax on the way out. They're forgetting about the compounding that's going on in the interim and the fact that the probability is, unless you have extremely large pots weighted to one person in a household only, then the total effective rate is going to be multiples lower than the relief that you got on the way in. End of rant. What about if you're under 65 or under 66? So the total effective rate for 110,000 for the couple in that scenario works out at 23%. But again, that's for under 60. So if you're retiring in your 50s with that level of income, 23% is approximate total effective household tax rate that you will be paying on income from pension, rental income, or other earned income that you might have, or directorships or passive income that you might have got going on. So that's very, very reasonable. I think most people would agree when you look at a total effective rate. But what if you're single, under 66? Let's say you're a single person, you've retired at 50, you have your money made, and you're drawing 80 grand ARF income yourself, let's say from a 2 million pension pot, plus another, say, 30,000 rental income that you've got going in. So you have 110,000 total income in your name only, and you're a single person in the eyes of the revenue. Instead of paying total effective tax of 23%, as we saw for a couple under 66, your total effective tax rate will be closer to 36%. So quite a jump. taking home 70,000 of the gross 110,000 earnings. So quite a difference in that scenario. 35, 36% assumed in that scenario. But importantly, not 100%. Or not bigger, not, certainly importantly not 100%, but not 50%. All right. It's 36%. It's approximately a third of your total gross will be due in tax until you pass that age threshold, whereby it will reduce somewhat. So, what are the key things? Well, particularly for couples, the double tax bans and credits. A single person can earn 44,000 in 2025 before they go into the higher rate, whereas a married couple benefits from an increased standard rate cutoff of 53,000 plus an additional 35,000 max, so 88,000 they can earn into the household at the 20% bracket. The age credits can substantially reduce couples' tax liability compared to single individuals. Ultimately, ARF withdrawals, optimizing the ARF withdrawals is an important consideration, and flexibility. And that goes back to everything that we've discussed over the last year or two or three, indeed, in terms of optimizing your pots, looking at the sequence of drawdown, maybe having separate PRSA pots and having a phased drawdown where you're staggering the income, staying within bands. Certainly, both parties having significant portion of the income. All of those types of things can help to just reduce that total effective tax rate down to a level that is very satisfactory for the vast majority of people. And then finally, state pension. People kind of look down on the state pension, I think, but it is, if you were to look at that as a defined benefit, a defined benefit of 30 grand household income, if you were to try and replace that with a pension pot, you really are, you're looking at not a million miles off €1 million is what it's worth to us in that scenario as a household. If there's a couple have optimized and maximized that, it's worth 800-900 grand pretty comfortably if you were to replace that with a pension, a private pension, personal pension. It is absolutely valuable. Please don't ignore it. Please don't look down on it. Understand how you qualify. Make sure that you're making your contributions and optimizing it. It can be difficult to get straight answers and to get information on it from time to time, but certainly revenue are there to help, particularly if you can use the online systems. Definitely can get answers pretty quickly there on a very specific questions in relation to your own personal circumstances. That's where I would suggest one goes. But decisions and planning done many years in advance can pay huge dividends ultimately when it comes to retirement income planning and optimizing what is there to be made. I hope that helped. I do. It's important. And I think we all need to have a think about it. It might be 10, 20, 30 years away for some of us, for the lucky ones. But certainly do keep it. I'm 45 next year. I can't bloody believe it. I can't believe it. 45. What? How did that happen? I know. I hear you. I don't look nor sound it. I totally agree with you. But that's where we're heading. So we're the lucky ones. We're still going. We are the lucky ones. And speaking of lucky ones, I mentioned there was a few little Christmas lines for you to get you into the festive spirit or not, as the case may be. Classic tune. Chestnuts roasting on an open fire. Jack Frost nipping on your nose. Yuletide carols being sung by a choir. And folks dressed up like Eskimos. That last bit was out of tune, but I hope you get this sentiment. Thank you very much indeed for continuing to listen and engage with me over the last year. I had fun doing it. I hope it was helpful and possibly even enjoyable for you. I really appreciate you and I love what we're doing. So thank you very much indeed for listening. You are a legend. Talk to you in 2025.